Welcome to Access a Trader, the #1 community for high-level traders to learn valuable trends and strategies, connect with other top traders, and become consistently profitable. Click the link in the description of this video to receive a special offer on our revolutionary PS60 training, access to our daily chat room filled with experienced traders, and so much more. Space is limited, so make sure you don't miss out. We look forward to seeing you in the room.
Hey guys, good morning everybody. Hope everybody is having a great weekend. Welcome to episode number 3 of Pancakes and Pivots. Again, no pancakes, some pivots. Hopefully you guys are having a great weekend, and hopefully you guys are just enjoying your life, right? Because at the end of the day, it's all about enjoyment, fulfillment of one's life, and hopefully everybody is happy this morning. The good news is, if you're watching this, if you're hearing this, you're alive, you're kicking. Everything else is a cherry on top. So welcome. First episode was designing and creating an actionable trading list for the next day without wasting time, cutting out noise. Last week's episode was a value lesson in allocation of risk, especially for a new trader. And this morning's topic of pancakes and pivots, and again, I love saying that. I'm like a child, so I love saying the word pancakes and pivots over and over and over again. Does it really bring a smile to my face? You know, the little things in life. This week's topic will be the correlation between the 60-minute channels and adding value via the 5-minute interval. And also, what is the sneaky pivot, right? Everybody always asks me on social media, what's the sneaky pivot? What's the sneaky pivot? Well, I'll let you know. I'll let you know what the sneaky pivot is. Before we get started with that, again, for all you guys who are at home, this is the teaser version of the video, obviously. For all you guys who are in the live room or in the live webinar or in part of our part-time trader program and all that good stuff, you guys are obviously going to receive the full-length video. You guys are going to get the whole weekend option flow, the video watch list, and all that good stuff, right? All that good stuff. So, guys, welcome. Thank you very much. All seriousness, welcome aboard. Hope you guys are having a great day, and hopefully you guys will have a great experience within our group. So let's get started. So just a kind of a quick review from last week, and again, the theory of the stock market. I say this now every single week because, again, the more you see something, the more you hear something, the more there's a chance more subconsciously it's going to really stick in your subconscious. Okay, and trading is such a business of doing the same things, a lot of repetition, and again, because the market is not very creative. The market keeps on doing the same thing year in, year out. The only difference is a lot of traders don't know that, and they become victim to its to its mannerisms, and that's the bottom line. And when you talk about the stock market these days, again, people are talking about the Dow, and again, you could turn around and say, wow, look how great this Dow is doing. The funny thing is, every day it feels like the Dow is going up 100 points. So it feels like every single day the Dow could be like at 23,000, 28,000, 62,000. I don't even know anymore. I can't even keep up. But again, at the end of the day, especially for you new traders, remember the Dow Jones Industrial Average is only 30 stocks. That's it. It's only 30 stocks. It doesn't represent the global macro universe. Okay, it only represents 30 stocks. So when you have 25 out of the 30 stocks moving up 30, 40 cents, $1, $1.50, you're going to see an exaggerated move. And the bigger move within the highest weighted members in that group, like a Goldman Sachs, like an IBM, for example. And again, look at IBM, right? Wake up, talk about wake up for the dead. Talk about Halloween is getting close, that somebody actually woke up from the dead. So when you have a run like this on IBM, going from, 145 to, 162 in 3 sessions, yeah, you're going to have a very, very aggressive bias to the index, and that index is the Dow Jones Industrial Average. And when you look, for example, the old world stocks like an Intel, like a Microsoft, the Dow goes up 2%, right? 2%. Again, quick question to the peanut gallery. When was the last time you traded Procter & Gamble? Hold on, I'll take a sip of coffee. You guys let me know. That's my point. So the companies that are in the Dow Jones Industrial although some are tradable, right? You know, like a Goldman Sachs, you could have an aggressive move on Goldman Sachs. You know, if you traded IBM for the last couple of days, wake me up. But yeah, okay, you could trade a Goldman Sachs and IBM. And, you know, Intel's had a nice linear run for the last month and a half. But again, these are not tradable vehicles. So you'd have to take a position in them. For example, there's no bias up here, right? This is just a linear move. But when you have a tradable entry, for example, on Intel around the $36 level, now you're reaping the rewards of this linear move. So again, the Dow Jones Industrial Average, phenomenal. Nobody can say anything about it. 2% move, God bless. The market, though, that most traders are trading, the sexy, you know, I hate using the word sexy, but the sexy market, the meat and potatoes market, the market that you can actually create cash flow both on the swing side and the day trading side, didn't exactly replicate what the Dow Jones did. And if you look at the NASDAQ, okay, the NASDAQ rose 0.4% compared to the 2% gain in the Dow Jones Industrial Average. And what that basically continues to reaffirm, and this is why I keep on reiterating it, because again, a lot of new traders just don't know the difference, there's a massive disconnect of what the media is portraying as the hottest market of all time, which is not, okay, it's not, trust me, and the market that is incredibly tradable, right, which we see pretty much every single day, and that's the key. It's an incredibly tradable market versus a market that is quote-unquote incredibly hot. I would take the tradable market over the incredibly hot market every single day and every single week and every single month, because the incredible tradable market represents value. The incredible hot market represents linear and this is another way of selling ad space and everything that the media, the global media outlet, needs to do to create revenue. So hot market versus a value market, and we're actually getting it both there. The only difference is the value market, for me, was on the downside. And somebody could turn around to me and say, well, you must be getting crushed. Yeah, I'm not getting crushed. Matter of fact, the stocks that we trade, the beta names, again, they're portraying a whole different story than this whole linear market that we're seeing straight up here. And when you look at stocks, for example, like a Tesla, right? Like a Tesla this week, okay? Like a Tesla this week, and like an Amazon this week, right? And like an Apple this week, and like a Google this week. I think you guys are starting to get the picture, right? And like an Alibaba this week, right? Right? Alibaba and Nvidia. The market that I trade, okay, the market that I trade, and I probably, and you guys probably will, you know, correct me in the room, but I think the majority of our trading this week, I would have to say, was on the downside, okay, because that's where the value was. So when you're getting ranges on Amazon, $12 ranges, $5 ranges, $6 ranges, $4 ranges on a single candle, and yet the market's going up linear, again, the question remains, would you rather trade a hot linear market or a market of value? And this is kind of, again, when we talk about there is much less correlation between the stock market and a market that is incredibly tradable. So this week, again, beta, very, very weak, resulted in a lot of really good pivots, not aggressive pivots. I only caught maybe 2 or 3 aggressive pivots, because the ranges were so tight. So, for example, if you look at a stock like Tesla, and again, Tesla, you know, gave a couple of pretty decent opportunities, especially on Friday. But for the majority of the week, you had 4 or 5 candles going sideways before a single push. You had 4 or 5 candles sideways before giving an initial push. So when you have, a situation like that, you have to be very, very patient. But you can see just off the 60-minute channels how weak the leaders were. And again, you know, I'm not a bull, I'm not a bear, I'm an opportunist in the market. I'm a realist. I trade what's in front of me. And this week, we clearly got bias for the stocks that, at least that I trade 95% of the time, to the downside, and it created some opportunities. So let's quickly get into Friday's session. Ironically, Friday's session had actually some pretty decent action on the small cap market. So let's kind of review what we quickly did on Friday in the live webinar, and then we'll get into the meat and potatoes of our webinar. So a couple of names. So I started the day shorting Tesla. Okay, I woke up in the morning. And the first thing I see is JP Morgan out negative with $195 price target on Tesla, and I was like, yeah, okay, so what? But I said, you know what? It's Friday. It's Friday. There's a downgrade in the stock. The stock was bidding up about $1 at that point. So very little liquidity when I woke up. There was like nothing out there. There was like less than, I think, 6,000 shares traded when I woke up. So I was trying to hit some bids, and I got short some stock like at 352.70s, and I got short some stocks at 352s, but very little shares. It was impossible to get anything down. And when I left to drop off my kids at school, the stock went down to like 351.5. But there wasn't any real aggression. So I said, well, maybe people just don't see the news yet. Maybe it's not widely disseminated. And when I got back home, I really thought I was going to see like a 4 or 5 point move down on Tesla. That didn't happen. Matter of fact, the stock was literally the same place that I shorted it. So there's an old theory that I have, old theory, especially in trading, very, very basic theory, and that's whatever doesn't go down must go up. So it was very, very clear at that juncture for me. I covered Tesla with a cup of coffee gain, and we started talking about it on Morning Strategy. And I said, hey, if this thing goes red to green, you might want to take a shot on this thing. I didn't take the red to green trade. But if you guys saw what happened when Tesla went red to green, it exploded. It exploded up 2.5 points. And then Tesla got really, really weak. Okay, Tesla got really, really weak. So the first trade on Tesla, I made a cup of coffee, just wasn't rallying. I'm not going to sit there on a downgrade and wait for something miraculous to happen. It's either going to go or it's not going to go. So you have to make very, very quick decisions, especially when you're trading beta. So the stock started coming in here, and this was kind of the first pivot of the day. Here was your opening. Here's your opening candle. We had this thing on the watch list. Well, actually, I don't want to call it the watch list. The daily pivot list on Thursday going into Friday session. On that 347 break. Why was it 347? If you see the candle right here from the 1016 lows, that was a 347 break. I didn't take that 347 because the candle was too big. So it put in a low of like 346 and 346.60s. The next candle that broke that 346.60s, that's where I got short. I took like $1, I think $1 and change on the runner. Listen, the trade was fine. By the time Friday rolls around, I'm already exhausted. I'm just trying to get some cash flow before the end of the week. I'm just so tired. I put so much effort into the live webinar and speaking all day and all that good stuff that you see. So at that point, I'm just exhausted. So I took some decent cash flow on Tesla. First time around, I made a cup of coffee. Second time around, I made a little bit of cash flow. Other trades here. Letter X highlighted off our video from Thursday night, the $28 break. Steel stocks were very, very strong. You can see what Letter X did. AK Steel, the same thing. We talked about that 610 break. Broke 610, hit the linear regression line. And a lot of people say, well, it didn't perform as good as it should have. Well, yeah, but look, when you have all these lines, and a lot of people turn around and say, well, Dan, how come you have all these little silly lines? These little silly lines are the difference between understanding where a stock stops and understanding where you close your eyes and hope to God the stock goes your way. So it hit the linear regression line perfectly here off the 625. I think next week, if this thing reclaims the 625, 630, you should get a move to the 669s. But the steel stocks were definitely in play. A couple of other smaller cap names that did pretty well. DEST, this was right off our actionable pivot list. 247 went to 265, and a lot of you guys in the room do trade these little stocks. I try to facilitate everybody. Also, SRAX was a nice one as well. The $4 break right over here. Here's the top of this channel, right? Oh, actually, excuse me. Let me show you the 60-minute chart. Yep, let me show you the 60-minute chart. Here is the high of the channel. Again, you're always looking for stocks that are confirming supply. If you notice this candle, the high here is $4, hit the upper Bollinger Band, and it took 5 hours worth of data, and once it confirmed, it really had a really nice move, and a lot of you guys caught this thing for like a 10% move, so good job there. As well, LINU, another small cap. Ironically, the small caps actually did pretty well on Friday's session. We talked about that 230 break. That's what was on our list. We had the 230 break. Where was it? Yeah, right here. It was the 230 break. It was the high of these two candles. And again, not a huge move, went to 243. So for all you guys who are trading the small caps, look, there's a time and a place for them. They're not really for me. I'm not really... I'll trade them if I'm watching something. I know there's a chance that, it could get a lot of social media attention. Once the volume comes in, I get it. There is a place for them. 99% of the time, it's not going to be for me. So I didn't take these 3 little trades. Again, just not for me. But again, what's one man's trash is another man's treasure. So who am I to judge? God bless whatever's putting steaks in your freezer. God bless for that. Baidu, nice little pivot on Baidu as well. Here's a 60-minute channel on Baidu. It was right here, 60-minute channel. I knew it was only going to get to the whole number. There was about a 50-60 cent move there. Other than that, again, on Fridays I try to take it a little bit more easier. I did miss the Amazon pivot. I did miss the Amazon pivot right over here. At this point, I was just so tired. And again, people ask me all the time, well, why are you so tired? I mean, just click a mouse. Again, if you haven't traded for more than 2-3 years, you really don't understand how much mental equity we do put behind every single idea and every single pivot and all that good stuff, because it's just so emotional. Even though we're not trading emotionally, it does put in such an emotional charge into every single trade that it really sucks the life out of you. So by the time this Amazon pivot came on this 985, I was so exhausted. I just couldn't. I was looking at the screen and all I just saw was blurring numbers. I just didn't care at that point. At a certain point, you just gotta mentally just cut it off, just to kind of long term have a better effect on your trading. So unfortunately, I didn't take this pivot, but this 985 really did well, and it stopped perfectly on demand, which is around the 982 level. So good week. I mean, good week. There wasn't a lot of exaggeration. I caught a handful of trades that were exaggerated, but because the market was so strong, the quote unquote, the Dow Jones is so strong, and the NASDAQ, there was such a big disconnect on, especially a lot of these names, the channels were tighter, okay? And a lot of times when you're going to trade in an upward bias market and the channels are tighter to the downside, your cash flow ranges are going to be a lot smaller, and that's what we saw. But the clear bias was definitely on the downside, at least for me. A lot of bias was definitely to the downside this week. Alibaba, Nvidia, caught a lot of these trades. Nvidia, Alibaba, Tesla, obviously, greatest stock ever. Again, God bless you guys who are just completely one-way biased to Tesla because you guys hate it or you love it. I'm telling you, it's the greatest thing. It's probably top 3 greatest stocks I've ever traded. It's just really good. I don't know why people hate the stock or are so biased one way or another, but it really is just a phenomenal, especially cash flow trading stock off these pivots. And that's what we're gonna start today, guys. We're gonna start with the webinar. Again, episode 3 of Pancakes and Pivots, correlation between there's correlation between the 60-minute chart and the 5-minute interval, and obviously we're gonna work in our sneaky pivot. So let's get into it, guys. So what's a sneaky pivot, right, guys? For all you guys who are, been trading in the live webinar, especially in the last, we've been doing this now for 8 years, okay, over 8 years now. In the last 3.5, almost 4 years now, I stumbled onto these pivots. I went through, again, 2-3 days without making any money, and I was, a little bit frustrated. And I said to myself, well, what's changed in this market? Well, what am I not seeing? And anytime I run into 2 days or 3 days of not really losing money, but just not making money, I know there's something wrong, okay? And when something's wrong, it's very, very obvious. So I start back testing. And once a month, I really encourage every trader, if you're trading for a week or you're trading for 10 years or 20 years, just chart. I mean, chart every single, it doesn't have to be every week, but chart once a month. The same way I look at my sheets once a month and I look at any trade that really stands out to the negative side, I always chart and see exactly where I can find a very definitive edge. And that's where 3.5, 4 years ago, I found these things. 3 days in a row, I couldn't make any money. So I started back testing, and hours and hours of back testing that one weekend. And I started seeing a little bit of a correlation. I started seeing a correlation between all these little lines. And again, I didn't have all these little lines at that point, but I had enough. And I started seeing how stocks were, and I didn't know it back then, but stocks started stopping at supply, and they started stopping at demand. And I wanted to see what happens in between. What can I find in between that is going to give me an edge that I have never seen before? And that's where kind of the whole PS60 theory took off, and for the next 3.5 years, I kept on tweaking and tweaking and tweaking. And what I found about 2 weeks ago, 3 weeks ago, that there was definitely a big value in something that within the 60-minute channel that gave me even a more clearer look. Because again, remember, at the end of the day, there are 321-minute candles that people on social media tell you it's normal. Again, if 90% of the people are trading 90% away and 90% of those people don't make any money, why would you trade the same way as those people? And by the way, why would you be in the same stocks? But that's a whole different conversation. So this is a theory that you are trading 6 candles for the day, okay, compared to 321-minute candles. It completely removes the noise, it completely removes the opinions, it completely removes your emotions. All it does is paint a clearer picture. But what I did find about 2.5, 3 weeks ago was another edge into the value system, and it came within the 5-minute charts, and we'll talk about that in a second. But let's start with the sneaky pivot, okay? What is a sneaky pivot, why it's important, and where's our value? So let's use that. Let's use Tesla, for example, okay? Let's use Tesla. You want to make an example. You want to have an example with a stock that puts in a big range, because the bigger the range, the clearer the view will be, and you can really identify it. So here's the 60-minute view, right? So here's the 60-minute view on Tesla, okay? So let's go back to all the way over here, okay? Because I don't want to generate a lot of candles for no reason. So let's go all the way over here, okay? So this is basically a week view of Tesla, okay? So instead of seeing this, right, which again, please raise your hand to explain to me which way the stock is going, right? I'll wait, okay? So you let me know which way the stock is going based on all this information. Okay, that's great. Okay, so now that we're back to normal. So here's basically the here's basically the week view of Tesla. Okay, this is basically 5 days worth of Tesla. A lot easier to visually, just a lot easier to figure out which way the stock is going, because every single one of these candles represent a beginning, right? So for example, every single candle will represent a beginning, it represents an end, and all this in between is completely irrelevant to us, right? Completely irrelevant to us. So majority of traders, okay, through their, whether they start trading or they've been trading for, for a long, long time, they are trained, because every book, website tells you that there's 2 ranges, right? There's the top of the range and there's the bottom of the range, right? I think everybody, right guys, I think everybody, when you first started looking at charts, whether it's somebody showing you the value of those charts, or you're kind of looking at themselves, you're looking at 2 things. You're looking, for example, at the breakout, right? You're looking at the breakout and you're looking at the breakdown. So if you guys remember, right, everybody on social media was screaming 360 break, 360 break, right? This is the daily chart, right? 360 break on Tesla, 360 break on Tesla. Oh man, if it gets above 360, it's going to go. 360 is going to go. 360 is going to go, right? That's the top of the range, right guys? That's the top of the range. That's what you've been taught to, taught to look at. And the bottom of the range as well. Well, Tesla, for the bear case, well, Tesla, 347, 347, 347. If it breaks down 347, it's going to go, right? So here's what we learned. That's all true, right, guys? That's all true. Think about it. When Tesla broke out, quote unquote, broke out at 360, what happened to the stock, right? 360 broke out, the stock went to 363, right? That's correct. When the stock broke down on Friday below this 347 level, what happened? Well, the stock went to 344. So you're not wrong, okay? When you look at the top of the range and you look at the bottom of the range, you're not wrong. But there's a problem with that, okay? All the value, okay, this is the 2 pieces of bread, okay? This is the 2 pieces of bread you're looking at. What we want is the meat, okay? So when you're going to, for example, when you're going to your favorite burger restaurant, right? Whether it's whether it's Five Guys or Shake Shack, whatever the greatest burger, or you go to one of these steakhouses and order one of these Kobe burgers for like $90. Damn right, $90 for one of these burgers, right? You don't care about the bun, ooh, the sesame bun or the ciabatta bun. You don't care about the bun. You don't care about the lettuce and the tomato and what would you like on it. You care about the burger. You care about the meat, because that's what you're paying the $90 for the Kobe burger. You're paying for that cut of meat. So everybody, and again, they're not wrong. Everybody who's buying these breakouts and shorting these breakdowns, they're not wrong. But what do you do for the initial 12 to 15 days, the 18 days, the 27 days that the stock is consolidating? What do you do? Not trade the stock? Well, I'm not doing anything until it breaks out above 360 or it breaks down below 347. What happens in between? Why is the in-between completely neglected, right? It's like having 3 kids. You got the 16-year-old, you got the newborn. You tell me you're going to neglect the 6-year-old because he's not the firstborn or he's not the lastborn? You're not going to neglect them. You love them all the same. Trading exactly the same way. The sneaky candles are exactly the same way. You're not neglecting the chart because it hasn't broken out or broken down in 3 weeks. That is where your value is. That's where your meat is. That's where you're signing your name on the credit card for the $90 Kobe burger that you just purchased. It's not because of the bun, right? It's not because of the honey mustard or anything else in between. Not for the curly fries. You're paying for the meat. And that's exactly what we're talking about here. So when you're looking at the 60-minute channel, okay, obviously, again, you have the 60-minute channel, the top of the range here. You have the bottom of the range here. And again, here's where we talk about all the value, guys. All this right here, bite after bite after bite. That damn cow that died for you to have that $90 burger. You're eating it, baby. You're eating it. You're loving it. Your face is all greasy. You look horrible. Your wife is disgusted that she's sitting on the table with you. But this is where the value is. This is where your enjoyment is. And this is where you are getting fat. And let's talk about it. Okay, guys, let's talk about it right now. So what's a sneaky pivot? Okay, 6 candles in the day, right, guys? There's 6 candles of the day. So for example, let's take this day, for example, okay? We'll kind of work our way up so you can see the whole picture. I'm not just kind of picking and choosing. I just want to start with this day because, I don't want to scroll all the way to the left because I'm going to just, waste my time. It's all the same thing. So here's what we have here, right? Here's what we have here. So we know the breakout, 360. We know the breakdown, 347. Let's talk about the sneakiness. So Tesla goes down. You guys remember? And again, I don't even remember what the news was, right? Does anybody even care what the news was? When the stock goes up a lot and the stock goes down a lot, what's the difference? Let's trade the stock. Let's trade the pivots, make some money. So the stock gaps down, like $7 or so. And the next candle, right? The next candle or so, it puts in a low here of 347.70 and puts in a high of 354.40. So the normal trading wave saying, okay, I'm going to get long above 354.50 and I'm going to get short above below 347. Cool. So a lot of times what happens is, and this is where people always ask me, well, Dan, what about shorting Tesla at the lows? Dan, what about buying Tesla at the highs? Yeah, like I say every single day. Of course you can do it. Why couldn't you do it? Of course you can do it. But again, it's not a pivot. It's not, all you're doing is buying highs and selling lows. So, any monkey could do that. Any 6-year-old can click a mouse and say, all right, Daddy, show me, I turn my 6-year-old daughter and say, all right, well, she's 8 now. But I could turn to her and say, well, where's the top of this candle? She could point. She has eyes. Where's the bottom of the candle? She could point. Okay. But the key is when you're buying highs and you're selling lows, yeah, you can get a 20, 30 cent move or you can get a $2, $3 move. We don't know. But that's not where our value is. Our value is finding areas in the chart, sneaky candles, where we can get the biggest bang for our buck. So let's kind of review this. So here, put it in a low, right? This puts in a low of 347.70, right? Everybody see that? 347.70. So the next candle that confirms it only goes down 50 cents. Again, to my point, if you're shorting lows or you're buying highs, it's very, very unpredictable how strong or weak the next move can be. It could be $2, sometimes it could be 20 cents. We don't know. But here is a perfect example of that, okay? Here's a perfect example of that, why I say it's a 60-40 proposition. You don't know how big it is. So the stock held, right, held the bottom of the range, and it started moving back up, right? Started moving back up. Does everybody see here how it hits supply? Right, guys? Guys, do me a favor. Type 1 in the channel. Does everybody see here how it hits supply here? Right, guys? You see how it hits supply here, guys? Okay. So, again, if you go back to the whole theory of the PS60 theory is stocks trade from supply to supply, and they trade from demand to demand. That's the way they go. Again, stocks don't randomly stop. They stop at supply. So knowing this, right, the emotional buyers bought the stock at 350 and a half, and the technical sellers sold stock 350 and a half. And the stock obviously came in a little bit. So the whole theory of the PS60 theory is stocks need to confirm supply or demand, and we need, right? What do we need? We need space. We need space to get to the next supply zone. So if you notice here, this was the first value candle of the day. Okay, this was literally the first value candle of the day because, again, it had everything that we were looking for. We had a stock that stopped at supply. Okay, we had a stock that stopped at supply. And then we had the next confirmation candle, okay, that we knew if it started building over the last highest point of supply, that we had a chance that the stock can go to the next supply zone. So look what happened. Let's go through the movie, right? Let's go through the movie together, okay? We know the beginning, we know the ending, we know the beginning, we need to see what's in the middle. So here is a first example of a sneaky pivot, right? Nobody in their right minds, at least nobody who trades the market normally, would ever look at this area because it doesn't make a difference. Well, Dan, it's not 354 breakout, it's not 347 breakout. Well, what's the sneaky pivot? What's the sneaky pivot? Well, again, that's exactly the whole point of arbitrage. It's the whole point of backtesting, to figuring these things out. And 4 years ago, 3.5 or 4 years ago, I figured it out. There's an area there that we can consistently get high probability setups without anybody even looking at them, right? Even knowing that they existed. And they work a very, very good high percentage of the time. Again, you guys know what we do in the room here. I don't want to use the percentage. You guys kind of know by now. So here's a first example of a sneaky pivot. A stock stopping at supply, the next candle, again, we wait, we know the top of the price, so we need for this thing to confirm. And once it started building there, look what happened, guys. Look what it traded, right? Right? If you believe in the theory that stocks trade supply to supply to supply and demand to demand to demand, look where the stock stopped. Right, guys? Everybody see how it stopped at supply, this green number? Right, guys? Do me a favor, type 1 in the channel. You see what happened here? So when the stocks hit supply, what happens? They go lower, right? So again, old world theory is, well, the next breakdown for the stock is right here, which is 347. Yeah, that's the old world of thinking. We're looking for sneaky candles. We're looking for value. So look what happened here, guys. Okay, check out what happened. So the next candle did not take out the previous highs. So what you guys should be doing is have a 60-minute chart up, okay? Have a 60-minute chart up, but next to it, if you guys notice on all my charts now, okay, if you guys notice on all my charts now, I have a 60-minute view, for example, on Tesla, and a 5-minute view, okay? I have a 60-minute view on Netflix, and I have a 5-minute view. I have a 60-minute view on Amazon, and I have a 5-minute view. What you don't see, I have another chart on the other side of my screen here. Here's a 60-minute, and I have another 5-minute on Google. So it's very, very important. It's like that trade. Joe, remember that trade? I think it was Alibaba on Thursday that it looked like it was going to break out in the 60-minute, and I said the stock is only going to go up like 6-7 cents. You remember that? And that's exactly what happened. There wasn't enough room. There was a supply zone on a 5-minute chart, and the stock hit that supply zone and sold off 50 cents. So it's incredibly important. And again, when we say do back testing, that's what I'm looking for. And believe me, I've already looked at the 15-minute, the 30-minute, all these correlations. The best correlated view that I've seen was a 5-minute view within that 60-minute interval, okay? Any questions, guys? For the next 5-10 minutes, we'll do some questions, and then I got 2 soccer games to attend. All right, so what we're going to do is every week, guys, again, every single week, we are going to do these series every single week. Again, I think within a year, if you can build up a great library that you can really go to and say, here's what I'm looking for this week. Let me go back to it. You're going to create a tremendous video library, okay? And the greatest part about it is, like, everything is live, man. There is no editing. There is no trick photography. It's very tough to trick somebody when you say, hey, guys, we're buying the stock at 52, and the stock goes to 54. It's very, very tough to trick somebody what would happen. Your eyes are, what's great about these pivots are nobody trades them except for us, okay? Nobody trades them. We have a defined edge with them. And I can explain it once to somebody, and if they never saw it in real time, they think they could be getting over on me. You'll never get it once, but the more and more you see it, screen time, playing out, it really does click in your head. And when it does, and again, a lot of you guys know, it becomes magical. Okay, it becomes magical. So the greatest thing about the live webinar, it's live. And the second thing is, again, I got your back. You know, if you really practice the way the theory is played out, you're going to do very, very well. Again, there's people in the room, and they'll share their experience with you. They're having some phenomenal runs, phenomenal. And again, they're having the phenomenal runs because they are sticking within the guidelines of the theory. If you don't stick within the guidelines of the theory, what happened is your edge is completely disappearing. Okay, guys. So everybody, guys, have a great weekend. I want to thank you guys for coming out. This video will go out for editing to our terrific team at Access to Trader. Also, guys, by the way, and this is kind of a little preview, you guys will also be getting a very, very big added bonus. Okay, what you guys don't know is Kenyon is a very successful life coach. Okay, he has these crazy speaking engagements that he gets, you know, compensated very, very well for. And he's going to be sharing that with you guys. So we're going to be the only platform around anywhere on this whole cyberspace with a built-in life coach. Okay, which is pretty good. I personally need a life coach, man. So guys, have a great weekend, everybody. A lot of good things are happening, as you guys can see. The rebranding of the company has been phenomenal. But the most important part is the trading, building the skills, and having longevity. Guys, have a great weekend, everybody. God bless. I'll see you all tomorrow. Take care, guys.